Hey everybody, welcome to the morning market briefing. It's Thursday, February 12th, 2026. Hope you're doing well out there. Having a real hard time adjusting to the 2026 thing still. But
yes,
what's most concerning is I tend to want to say 2024.
Ooh.
So I'm falling back a year every time. So we'll see what happens. Initial jobless claims, Tom. People have been talking a lot about the employment picture. We've got some questions from some super users about it. But initial jobless claims coming in right now.
We came in at 227,000, which is just over the estimate of 223 and just below last month, which was 231. So not much to read there. So I think the number of firings has been pretty consistent. The 4-week rolling average is about 219,000. So it's not really moving the needle.
There's not much of a trend, but it does, I think, underscore maybe our confusion by yesterday's report.
Yep.
Because when you're getting other anecdotal data that is coming through in line almost exactly with expectation, or splitting the middle between what the expectation was and the last reading was, it makes the data from yesterday seem potentially like an outlier.
Yep. So we got a question yesterday on the call. I basically said I think that unemployment is actually closer to 5%, and the question was essentially why. What is it that makes you think that? Because all the data sort of indicates that's not the case, and I think it's not a very scientific answer, but it's mostly just vibes. I mean, to be honest, we've eliminated so many of the jobs that were gained. Pretty much all of the jobs that came through when Biden was in office were either in government or in healthcare.
Yep.
And then we had a massive revision in the early part of 2025 when Jay Powell said the jobs numbers were awesome, and then they were immediately revised down the next day. Turns out they were not awesome, and then the Bureau of Labor Statistics head was fired, which then people were mad, saying that Trump was trying to alter the numbers in his favor, even though the numbers had been obviously altered in Biden's favor for 4 straight years to the tune of millions of fake jobs. And somehow all the way along that run of eliminating these jobs and revising everything down, the unemployment rate has been pretty stable, right?
Very stable.
I mean, there's been no change. So if it's a very basic equation of employed people divided by people by looking for jobs, and then you remove 2 million employed people, but the people not looking for jobs stays the same, your denominator stays the same, the equation, in my mind, can't come out to the same answer.
It shouldn't.
It's like if you have 5 divided by 4, then you have 3 divided by 4, the answer is not going to be the same.
I think part of the challenge that we're dealing with, and I think that's a great recap of just kind of the employment narrative. We talked about this it was probably the third quarter macro presentation of 2024. We talked about job creation, and this is prior to the massive revision in which millions of jobs were wiped off the board. Prior to that point, we talked about the lack of true productive increases in the private sector in terms of employment that really dated back, frankly, to just after the quick rebound during COVID. People got fired and then immediately hired back. After that period, there really was no private sector job creation whatsoever up until that point in 2024, and arguably even longer than that. So what's interesting to me is we've got 2 things going on. One, I don't know that we've got a lot of confidence in any of these employment figures. I mean, as we opened this call with, we have this data that's right in line with expectations set, frankly, by the exact same people who were massively off on their expectations on the report we got yesterday. It's hard to see through that and say, okay, this is really good data. I think some of that is a structural challenge. I think it is actually surprisingly difficult, for whatever reason, to figure out what the total headcount is of people employed. I don't know why that is so challenging. It seems like it would be fairly straightforward to at least set a baseline and say, this is the number of people that had taxes withheld from their paychecks this week, as an example.
Yep.
Are there more people doing so next week, or are there fewer? That would give you a measurable trend line, and that data, I have to think, is available to the Treasury.
It has to be.
because I'm having money withheld every week. If next week I don't, okay, we lost one.
Yep.
I think we grapple with data, and I think the concerning thing for me is major decisions are made off data that we don't think is all that accurate. Not only that, but it's maybe not reasonable to expect it to be super accurate. And even things like GDP, we've talked a lot about GDP, what the projections are for this year. We obviously use that for growth. I would jump in here and say we've not picked apart the GDP number the way we have the jobs reports, just because it has not been so discernibly immediately wrong in real time.
The estimates have been wrong.
The estimates have consistently been wrong, but I also don't know that our GDP readings are exactly accurate.
Yeah, and they revise them. You know, you get 3-4 shots, and then 10 years later they go, "Was this really it?" And then they pencil that in later.
So I think on the employment picture, the number I'm personally, as I view the economy, I'm really less concerned with what the actual number reads out, because I completely agree. It does not make sense that we are not seeing an uptick in the percentage of folks that are unemployed. I also don't know that that's the single biggest driver of even the employment picture as we're reading through the economy, so much as, well, where are jobs being created and where are they being lost? Because we just came out of a period in which jobs were being created, even if they weren't revised out. If we just buy the narrative that those jobs were created in 2023, they were created in early 2024, were they the kind of jobs that we would view as productive to the economy? Well, if they were exclusively in healthcare and in government, my personal view is no. They were jobs. They checked a box, and maybe they contributed to stronger employment. But is that the direction that we need to be heading to see meaningful growth? I would argue no, and I think the lack of economic growth during that period would suggest that my argument might be correct.
Yeah, I think there's a couple points there. One, the numbers we got yesterday would be harder to fudge than numbers we've seen in the past, which is that we got 172,000 gains in the private sector, which I would score as excellent if that is true. We don't know that to be the true, but it'd be harder to fudge. And we got a net loss in government jobs to the tune of negative 42,000, which I would argue is also a plus. Now, if those numbers are accurate, one, and two, sustainable, then we should be extremely bullish, because there are basically two things that happened during the Biden administration. One, they made up a bunch of government jobs, and two, almost no one who was born here got a new job. I mean, you can look at, they have stats on native-born versus immigrant jobs. There were like 2 million jobs gained by non-native-born people, and there were basically no jobs gained by native people. Now, that is reversed. Now, is that because whoever is calculating the jobs is a different person who wants to, push the political football towards Trump? That's certainly possible.
It's certainly possible, but I also would say if that is the outcome, that is a reasonable outcome of Trump's policies.
Yeah, and
I'm not saying they're the right policies, but if he says I want these things to stop, we should be seeing employment readings that look like what we're seeing.
Yeah, and they would be, I would argue, more bullish for the U.S. economy than the previous types of jobs. I mean, think about, I used this example the other day. If every time a government employee gets a job, you get a 0 on your homework, your average is coming down, and that's your GDP. And every time you eliminate a 0 and replace it with even a 60, someone who's attempting to create GDP, your average goes up huge, because a 0 is so heavily weighted when it comes to averaging things out. So if we took 42,000 zeros off the board and put up 172,000
60s
passing grades, suddenly we're going from an F to a C+. And that's, C's get degrees. Yeah, certainly in my case. And so I think that's something to be so cognizant of. What are the types of jobs, even if they're wrong and the numbers are lower, maybe there are fewer government jobs and fewer private sector jobs, but the number is still net positive towards the direction of private sector, then we should be more bullish than we have been in the last 4 years.
And I think for me, paying attention to the nuance and the trend of these data points, not the unemployment rate, is, I think, a better lens through which to be viewing the employment picture right
Yeah.
now. And I realize that there's going to be people that love data and really have a lot of respect for the institutions and, love the BLS. And I get that. I appreciate that. I don't think you're a dum-dum to say I'm following the official data provided the way it's always been provided with disclosed tweaks to the formula. Okay. I'm just of the mindset that I don't think it's all that accurate. I think the trends of it can be more meaningful.
I mean, these are still bureaucrats. It's the Bureau of Labor Statistics. These are also,
Yep.
the leeches on our tax dollars. So if we're going to be paying them to come up with the numbers, let's get the numbers right, people,
I mean, it is crazy to me how difficult it is, apparently, to find this number.
Oh, it's ridiculous. Especially with all, I mean, that's the thing is government stinks at doing everything. If we gave this to any ADP, we said, hey, you plug this into Meta AI and say, figure out how many people were employed last week. I bet they come up with a much more accurate number in 10 minutes.
Yeah.
But that being said, the bond market reacted pretty strongly yesterday. We saw real flattening, which is to say that there was a lot of cut expectations sucked out of the market.
Yep.
So the front end came up. The long end was essentially unchanged. And then we basically moved back 100% to where we were before that data yesterday. So it's been digested, and everyone just kind of said, we shouldn't have reacted to that, which I would agree with. So
yeah, and I tend to think that I think the rate, I don't know if you would agree with this or if you have a data point on this, Tom, but I feel like take the U.S. 10-year, for instance. I feel like the market's got a pretty good grasp on where we are, the bond market, in the sense that whether we're talking about 3 cuts or 2, that's not all that meaningful in terms of digestion compared to where we were a couple of years ago when,
could we have 2 or 3 hikes in a single meeting?
Yeah.
Yeah.
I think we're in a period in which people are really reaching for headlines to have a meaningful impact on rates. And I don't know what news could come out right now where we'd see quick movement on the 10-year.
Yeah. Well, it's the jobs number was extreme doom and gloom for cuts, and that sort of started to fade. Then we had the 10-year auction, and then the narrative on that was this 10-year auction was a disaster. They tried to issue it at a 4.16, and they ended up getting 4.17 for the bonds, which because the bond market was one day earlier at a 4.14 and earlier that day at a 4.20, you can say that's a pretty reasonable level.
Yeah.
And not only that, but if you look back at the 3 previous auctions, they've gone off at 4.17, 4.17, and 4.17. So we've actually had no bond volatility.
There is none.
I mean, there was a little bit of intraday yesterday, but it's just a snooze fest outright, because I think, and I've been saying this for 6 months now, I think that the fair value of the 10-year is roughly 4.20.
Yep.
And so we've basically been anywhere from a 4.10 to a 4.30 for the last 6 months.
And every time it makes one of those moves,
Yeah.
when it goes from 4.10 to 4.17 or 4.20 to 4.28, people react.
Yeah. And the long bond, I mean, like when we got a big blowout last week, we're buying long bonds at 5%. Guess where the 30-year is today? It's at a 4.77. So we can't buy those right now. I mean, we can get creative, but like that was a great opportunity because everyone said, oh, inflation is going to the moon. The 10-year should be, or the 30-year should be at 7%, which it will not get to.
No.
There's no chance of that. And so 5 was a really nice buy.
Cisco had earnings down 7%. Margin concerns kind of beating them up a little bit there.
Yeah, they're getting whacked. I mean, this is the story we've seen with a lot of these companies is the numbers are very good. Cisco had banner numbers in revenue and EPS, and they basically were like, hey, we're getting squeezed a little bit on margin. Stop me if you heard this before, but AI chips are getting real tough and real expensive. And then they guided to a little bit less gross margin going forward, and the stock's down 7%. I mean, that's just what we've seen across the board. I mean, anywhere that's even remotely tech-oriented, if the numbers are off by a little bit, we're just getting whacked.
Which is interesting to me because I do feel like even a couple weeks ago when we had our economic symposium, one of the things that we talked about in terms of tailwinds and headwinds for the market, we put up a nice little graphic, and we've referenced it, I think, on this call before as well. But, it felt like the tailwinds for the year really were coming at the beginning of the year. Later in the year, expecting some more resistance and some volatility as we comped over more difficult periods. Interestingly, it does seem like the bar for execution has been set so high as we roll through the tail end of this earnings season that perhaps the tailwind that we anticipated being here for the first 2 quarters, maybe it's just not there. Not to the degree that we thought.
And maybe that's healthy because, everyone talks about, man, this market's so overvalued. It's so overvalued. We're going to hit 7,000 maybe today on the S&P 500. We just hit 50,000 on the Dow. But what's driving that is all the companies in the bottom, call it 250 companies that are all doing really well. And it's counteracting the fact that a lot of these, we've had the SaaS apocalypse and, the semiconductors are not doing well. NVIDIA hasn't hit a new high in a while. But the rest of the market is getting some love, and that's a very healthy thing, I think. And so the market is actually not really on average getting that much more overvalued because the most overvalued companies are going down and the least overvalued companies are going up. So I think that's something to keep in the back of your mind where,
if you're concerned about valuations, I think that's a fair point to have at any point in the cycle. But if Cisco is beating on earnings per share and the stock is down 7%, guess what? Valuations came down.
Yeah, Johnson & Johnson is crushing this year. Defense companies are crushing this year. That has not been the case for a long time. ExxonMobil's done well. I mean, there's a bunch of companies that are market blue chip stocks that have been boring and ignored for a long time, and they're starting to move the right direction while everything else is coming down a little bit. And it's just basically been, we're up 3%. It's not a big deal.
Yeah. McDonald's basically flat. They are following Pepsi's lead, cutting some prices. I'm not a frequent McDonald's guy.
I've had McDonald's in a long time either.
I'd say I get it maybe 2 or 3 times a year, and it's, if I'm being honest with the people out there, it's one of the two. Those are 2 or 3 of the best meals of the year. I mean, it's just unbelievably
McDonald's
good.
breakfast.
You feel horrible immediately after. It's not like it's not like you go to Waffle House and you're like, man, that was good, and a couple hours later you're paying for it. Like McDonald's, immediate regret sets in, but it's so good while you're in it. And I think the theme that I've had from them, and you made a comparison to Starbucks in the notes, Tom, the theme that I've had because I'm not there frequently, it's incredibly difficult to order food at McDonald's. I mean, their menu is like 8 panels. There's so many options. Like even like getting the kids a Happy Meal, it's like you got to make 3 choices to do it.
They have skew.
Yeah.
They get too many skews.
Yeah, they're skewed up.
Yeah. And that was, I mean, when Chipotle, which people forget was owned by McDonald's at one time, that was the big thing is it's like you have 7 ingredients and you can make a zillion different combinations and permutations for our statistics people out there. And then that was the big thing with Starbucks too, and they had skew. It was just like you can get cold foam. I don't even know what that is.
Yeah. Doesn't sound fun.
It doesn't sound like it tastes good.
Yeah.
It seems like something you find in the bottom of a log when you rolled it over. You're like, ooh, look at that cold foam all over there. Is that a mushroom? What is that? But yeah, I think they're getting back to basics, which is cheap food for people who need cheap food, and they've gotten really expensive, and they're pushing the loyalty points. They're cutting prices, and I think that they could be back on track. I mean, we've just had, mission creep. Yep. McDonald's, the pink slime stuff when people went after McDonald's for making low quality food really did people a disservice because as someone who has been extremely poor in their life, I needed some of that pink slime to survive.
Yeah.
It was at that time cheaper than going to the grocery store. Now it's not cheaper than going to the grocery store, and the grocery store isn't cheap either.
Yeah.
So, I mean, they've got away from what they were trying to do. Goldman Sachs did it with going to Marcus. Starbucks did it by being somewhere you want to interact with people who work there.
Yeah. Washington State, on the heels of the big Seattle Seahawks Super Bowl victory, said, hey, let's roll out the millionaire's tax.
Yeah, so Washington notably does not have a state income tax, making them the golden, the emerald city, Seattle's nickname, of the West Coast, where you can live there and not pay a state income tax. I will say, having visited Seattle, they go hard at the tolls. They love a toll there. And they're basically saying they're going to put a 9.9% income tax on any earnings over $1 million in people in the state of Washington, which is, it's tough because one, they had a referendum in 2021 where they asked, should we institute a state income tax? And they got a 68% no vote from that. So the people don't want it, but that doesn't matter. No. We've had a lot of things that have happened over the last 5 years where people don't want these things, but
they're happening.
Those are in charge force these down our throats. And I bet they can find a judge that's going to sign off on it with no problem.
I'm
because
sure
there's been a lot of that going around as well. But I think one, it's unfortunately for Ben and Chief Washington correspondent, my buddy Jimmy, who I was texting about this with last night. The Seahawks are not going to re-sign anybody.
No,
because why would you do that? You're basically going to take a 10%
on everything.
Everything. Plus, part of it is also the jock tax. There's been a lot of headlines about how Sam Darnold lost money
in the Super Bowl
because he got hit by the California state jock tax. Well, they're going to add that in too. So no one's going to want to play for the Seahawks.
So I hope everybody liked watching Kenneth Walker win Super Bowl MVP in the last year of his rookie deal.
Yeah.
He will not be wearing the navy and green.
He's going to go to Dallas, where he will be overpaid to be probably pretty average.
Yep.
And so, yeah, it's tough, and it makes me wonder about what's going to happen with the munis, because either they're going to have to repaper them and say that these are now state tax free, or they won't, in which case they will probably go the way of California and New York bonds, which is nobody's going to want them because everyone with money is going to exit the state of Washington. And I was texting my buddy Jimmy. I just don't understand if there are so many people who are on board with these things, but are they really on board with them? Like, the average person doesn't want this in California. The average person in New York probably doesn't want massive taxes. And now the people of Washington have voted, 2 to 1 that they do not want a state income tax on this. But the people who are on board with these insane ideas are so vocal and so in your face about it that a lot of people just don't do anything and sort of capitulate. And now I think there's going to be a mass economic shift from California, New York, now Washington, where, Washington, you've got...
It's been happening in California. I'm a little surprised that the pace has not been more rapid out of New York.
Yeah.
But...
you've got Amazon, Microsoft, Starbucks, Boeing. Washington, Costco. There's some of these massive companies, huge names. Nobody's going to want to be an executive for them or have their headquarters there if they're going to get crushed, because there's also a business part where it's, if you make the businesses are, I think, exempt from this if they have revenues under $300,000, and then it tapers off to $600,000. But I can tell you that it probably doesn't take Costco very long to make $600,000.
A $300,000 revenue business is
pretty small.
That's
if you got
a lifestyle business. I'm not.
If you got 30% margins,
but you better not have employees.
Yeah. So it's pretty. It's tough, but it seems like they're just going to ram it through. The people don't want it, but they've got a majority, obviously, in Washington of those in charge, probably all the judges as well, the Supreme Court of Washington. So
it'll get through.
But apparently it's unconstitutional, because in the state of Washington there can be no tax that is not a flat tax. But according to Chief Washington correspondent Jimmy, you can
rewrite it.
Yeah, they can basically. They're saying that it's an excise tax on excess earnings. So. Unbelievable.
It's wild.
So,
Bill Ackman taking a big stake in Meta through Pershing Square, his fund. $2 billion stake in Meta, about 10% of their portfolio. Specifically fired up about what they're doing in AI and how they're positioned in that space.
Yeah, Ackman obviously known to take big positions. I think they've only got 13 positions in that account, and it's like Google, Amazon, Meta. They notably exited Hilton Hotels. So that's a big stake for him, and he's got a lot of political clout right now, which is probably good to have him as an ally if you're Meta, because Zuckerberg consistently steps in it in that regard. So we'll see how it turns out. I'm actually pretty bullish on Meta from an AI perspective as well.
Nuveen buying Schroders, the largest standalone asset manager in the UK.
Yeah, so that'll be. This I threw on just because I was running out of content. Kind of a slow news day. We did a lot of talk of jobs, though, but Schroders is really like the last of the active managers. Think of them as like the 200-year-old Goldman Sachs of the UK. They've gotten squeezed a lot lately just because there's been so much passive investing. I think it's a good mix. So Nuveen is basically a huge muni shop that goes back to the 1800s. They've been putting out muni bonds since they were a thing, based in Chicago. I do a lot of reading of Nuveen's stuff because they're probably the best muni manager in the game. But
other than you.
Yeah, well, they've managed a lot more money, and they're about to manage even more. It's an interesting overlap, though, because you think UK asset manager mixing with munis are exclusively a U.S. thing, but they're merging. The plan is to merge them, and then, of course, Nuveen is actually a wholly owned subsidiary of TIAA, and so that'll be interesting. My thought is that it's probably a way to gain active management for pensions. TIA obviously has a ton of pensions. You can maybe throw some of their products into, the 401ks, the 403bs they manage, but they're going to be huge. I mean, they'll be at $2.5 trillion. I mean, they'll be behind BlackRock, but their business will be far more specific and siloed.
Yeah,
so
BlackRock's the everything shop.
Yeah. So, I mean, that's one of the last bastions of like standalone asset managers in the UK. And now it's going to be under the Teachers Insurance. I forget what the AA stands for, but people forget that like TIAA CREF it's like how Nabisco is the National Biscuit Company.
Yep.
So
good stuff. All right, we're going to wrap it up there. We will be back tomorrow morning for Friday the 13th.
Ooh.
Buckle up.
Tomorrow day is Friday the 13th.
Tomorrow day is Friday the 13th. Y'all have a great day. Talk to you soon.